Hey climbers, this is Climb by VSC, a weekly show about building and scaling startups in the world of climate innovation. My name is Jake Kapoor, General Partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak with a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've all heard enough of the doom and gloom, so we're sharing stories of innovation that lead to sustainable, positive change. In today's episode, my partner Vijay Chatta speaks with @One Ventures founder Tom Chi. Tom has had a successful career in scaling projects to global reach at companies like Microsoft, Yahoo, and Google, and has now established himself as one of the most thoughtful voices in climate investing. I can't wait for you all to hear from Tom. As always, I'm so happy that you've decided to join us. Now, let's climb.
Hi everybody, welcome back to another episode of Climb by VSC Ventures, where we talk to company builders in the climate technology space. Today, I'm really excited to have Tom Chi on board. He's a founding partner at @One Ventures, and they're focused on backing early stage startups that use technology to reduce our planetary's footprint. Tom has had a great career. He's worked at a variety of companies, sort of starting, back in the day, Fortune 500 companies from consultant to executive beyond. Helped grow Yahoo from 0 to 90 million users as Senior Director of Product and User Experience. Went on to work at Google X as Head of Product Experience, and his team developed Google Glass and Google's self-driving car. Tom also then went into the VC world and then struck it out with his own fund. I've gotten to know Tom over the last 2.5 years, and I've found him to be one of the smartest people in the space. So really excited to have you on board today. Tom, thanks for joining us. And yeah, tell us a little bit about your journey to @One Ventures.
Yeah, so as mentioned, I had a pretty long career in technology as an inventor, as a designer, as an engineer, and then eventually a senior manager and executive. In the intro, I helped to scale things like Yahoo Answers, Yahoo Search, a bunch of their social properties. So not all of Yahoo from 0 to 90 million, because it was past 90 million when I first joined. But it means I have a combination of invention experiences, executive experiences. I helped to run a couple multi-billion-dollar businesses across 44 countries. I'm a named inventor on 77 patents that span hardware, software, advanced algorithms, design, and some mechanical things. And relative to the journey to what I'm doing now, then, my formal training is in physics and electrical engineering, and I spent a lot of my early career doing really advanced engineering research. So super high-speed control systems with control bases that go down to 10 nanoseconds, autonomous robots that fly, crawl, and roll, though I'm now working on a robot to replant coral reefs. So that's like the first autonomous robot I'm working on that swims. I worked on advanced sensor fusion for medical imaging that blended, CT, MRI, and ultrasound data into kind of a combined sensor fused data set. I worked on cache coherent symmetric multiprocessors in terms of scaling out large, computing systems. So anyway, just had a background in building really advanced things, and then kind of moved into the software world, the web world, and was part of scaling up a bunch of properties at Yahoo. And that kind of led to learning a lot of that executive experience. And actually, the pertinent part of this is during that process, when I started making that executive salary in Silicon Valley, my wife suggested, hey, let's go get a vacation home out in Hawaii. And I was like, sure, we got the money, let's do it. So I got this place in Hawaii that was a 2-minute walk from the front door to an astoundingly beautiful coral reef. And when you're that close to something that beautiful, then every time I was out there, I'd spend a lot of time on the reef. And we had the place starting in 2006. And in 2011, I watched that reef go from every color of the rainbow and life coming out of every corner. I watched it turn to gray and brown and no life in less than 2 months. And what I'd witnessed was a mass bleaching and reef collapse event. And it kind of kicked off this whole journey of deeper understanding of how, close these climate changes were happening, how close these disruptions were going to be. That led to me understanding some really critical things about climate, which are still not really being talked about at large scale yet, which is my reef died. I went and talked with a bunch of coral scientists in order to understand what happened. They told me that it was because of thermal stress, and the thermal stress was related to the overall planet warming. And that's great. I mean, it's not great at all, but at least I knew what the cause was. But then as I dug into the statistics on warming, because I was like, man, this is happening so much sooner than the IPCC kind of indicated, I started to realize something really important about the communication from the IPCC. So the IPCC, from the methodology side, some really great research, really solid data, all that sort of thing. But they have kind of centralized their communication into a single metric around average temperature rise by the year 2100. And we hear this all the time. Let's keep it under 1.5 degrees C. Here's the 2-degree scenario. Here's the 3-degree scenario. Here's the 5-degree scenario. But this is all around a metric of average temperature rise. And what I realized after my coral reef died, I actually went back to a bunch of the raw data that kind of backs the IPCC reports. And I realized that there was another metric that was in the data that was moving quite substantially and was probably more important than the averages, which is the volatility of temperature was increasing way faster than the averages were increasing. And it's actually the volatility. So like what a 0.5 degree increase in one spot on the planet might mean, it may practically mean 5 degrees hotter in the summer, 4 degrees colder in the winter. And truthfully, if like nature was just 0.5 degree warmer every single day of the year, then most ecosystems would be fine. If nature was 1 degree warmer every single day of the year, most ecosystems would be fine. But it's that big swing in the volatility, the really high highs, the really low lows, the really wet wets, the really dry dries, that are basically causing the disruption and is driving the extinction. So it's really, the volatility is the killing edge of climate. It is not the average temperature rise. And we should be tracking volatility as the core metric because it's the one that is way closer to what is going to lead to human and ecosystem negative effects. Anyway, with that realization, I was like, okay, this looks very bad, because if you follow the volatility curves forward as opposed to the averages curves, and this was back in 2011, 2012, I was doing these calculations, I was following these curves forward, and I was like, man, if volatility keeps increasing in this way, within 10 years, we're going to be having massive, massive problems, right? We're going to be having major floods, major droughts, major fires, all that sort of thing. And this was just like projecting forward models based on the volatility. And now that said, if you think back to 2011, I don't even know that people remember that, but this is before the Paris Climate Accord was signed. This was, when people were still just talking about average temperature rise, sea level rise. And obviously some people were talking urgently, but certainly nobody was talking about volatility. And when I looked into the volatility numbers, I was like, we got the wrong story. The most important story is volatility. Honestly, the average temperature rise could increase by 0, but if the volatility kept increasing like that, then you would basically still extinct everything, right? Now, that said, they do move in concert. So I'm not saying that you could separate them, but I will tell you that the volatility is the killing aspect of it. The averages are less important. Now, that said, with that realization, I was like, oh my gosh, well, if I really believe my own calculations that within 10 years that these major negative events would be arriving, then what are you going to do about it? And, I was this person that had a lot of really good technical skills and some pretty good leadership skills. And I was like, well, let's see if I can do something productive for the climate with that. So being I was an executive at the time. So I was one of the executives that helped to, found and scale the Google X team. So I was the 6th person on the team. I was the head of product experience. I helped to scale it to about 300 people. We created the self-driving car, Google Glass, Project Loon, all that sort of thing. So given my executive background, my first thought was, well, let me just do it the way an executive would do, which is let me just go find some people to organize as opposed to do the work directly. And I kind of went around the world trying to go find the people that were doing the most compelling work. And I quickly started to rule out a number of folks that were at the forefront. And I don't mean this in a negative way, because I actually do think that these are earnest people that are smart, that are working hard. But I think they've been working hard on theories of change, which are not going to be the complete way that we solve this, right? So, back in 2011, 2012, when you talked about the theories of change, a lot of it was, well, we just need to politically organize. And if we're marching in the streets and if we put political pressure and we can get the right people into office and then we can force them to do those policies and then that's going to save the climate. And, we pushed pretty hard on that. But what we saw is, Obama did a number of improvements, wanted to push to a more blended energy mix, including more renewables, created the largest marine protected area ever created in history, protected a lot of our critical natural resources. And then Trump got into power and reversed instantly about half of it. And it's like, well, is this a viable theory of change? Is this a viable theory of change if you need to spend years and years politically organizing in order to get something through just for the thing to be undone in, 4 years later? Because that's not the level of continuity that we need to succeed at this task. We need to be on a clear, aggressive plan for 50 years. We can't necessarily be tossing back and forth every 4 years, every 5 years, depending on the political system. So I was like, okay, well, a lot of energy is going to that theory of change, and I don't know if that's going to really make it. It seems incomplete. I'm not saying there aren't some places where policy can help, but it seems incomplete. Another theory of change that was out there was launching those green businesses. And then I started looking into a lot of the green businesses at the time, and I would say easily 90% of them, and that's probably still being generous, it's well more than 90% of them back in 2011, 2012, were folks that were just trying to do a little bit better for the planet and then charging a big green premium for it. So this is where you get the t-shirts that have 2 recycled water bottles in them, or the $100 yoga pants with, 8 recycled water bottles, or the bamboo handled toothbrush, or the, straw that is made of paper. And you're like, well, I generally get what you're trying to go after, but when you talk about the displaced tonnage that you are moving over to the greener side of things, it's quite trivial. And when you talk about charging green premium for it, it sounds good on the business side of it, but because you're maybe making larger margins per unit sale and all that kind of thing. But in practice, you're never going to go displace the entire market like that. You're going to get the 1% of people that are willing to pay a bit more in order to have their consciences settled a bit. But that's not the majority of the market. So, yeah, and I don't say this to throw people under the bus. I mean, for example, I know that the people at a lot of these companies, like Allbirds, for example, they are good people that want to do good work in the world, and they're trying their best in order to go do it. But when you look at the shoe, it's not a higher performance shoe. It's not a cheaper shoe. It's just it's a shoe that's made of somewhat more sustainable materials. And given that it requires a green premium, because there's obviously a bunch of shoes that are less expensive that actually are higher performance relative to running or, protection from the elements and all that sort of thing, then you kind of think in the best case scenario, maybe they get 1% to 2% market share over 10 years. And that's over a time period where the global, demand for shoes is probably going to grow by 5 to 7%, just with population. And then you kind of look at that and you say well, that means we actually end this decade with more shoe waste than what we started, even though these, committed, hardworking people are pushing on this for a decade. We actually end up with more waste at the end of it. So I'm not even trying to say that they aren't smart people, that they aren't hardworking, but the target that you choose matters a lot. And, the kind of theories of change that were available back then were the political theory of change, the social business theory of change, largely built off of green premiums. And I was like, none of this stuff's going to get us there. And I kind of, those calculations actually led to me leaving Google and taking a sabbatical and going to all the places in the world where this ecological damage was happening. So I went to the places where, they were clear cutting the Southeast Asian rainforest and putting up the palm oil plantations. The places in the Amazon where they don't even bother with the timber. They just slash and burn in order to do soybean and cattle. The places where the glaciers were calving at 100x the rate compared to just 20 years prior. And by being close up with the actual damage, being close up with the situations that are helping to go drive that damage in the world, in terms of the local economic incentives around palm oil, around production of various things that are having us destroy the planet, then it just gave me a really intimate view of the kind of interconnections that if we could just nudge this here or change this here or move the target 3 degrees over there, then we could actually get a lot of things done. And there is, for a person who's a designer and engineer, and I know a bunch of your audience is that, then when you're fully surrounded by the totality of the problem, as opposed to the abstract numbers on the problem, then you can't help but start, thinking of solutions. So, if you have an abstract number like 850 million people don't have access to clean water, which is about the right number, then you honestly don't know what to do. But if you see why well projects are failing in Mali up close, or you see why actually there's plenty of water in Guatemala in the rainy season, but it's not all drinkable for these reasons, then you will actually start to come up with ways that you might be able to make a difference there, as opposed to just thinking about it abstractly in just the one big number. Now, of course, you need to be referent to the big number because ultimately you want to move the big number. But you will get the good solutions by being up close and in the weeds around the specific ways that things are going wrong on the ground. Anyhow, I did that. I met a bunch of entrepreneurs, and I met a lot of really compelling organizations that were doing work on the ground all around the world for the betterment of the planet and for society. And I started angel investing effectively. So brought some capital there, helped to organize some rounds, started mentoring the teams, and really got up to speed on the space. And at the time, I actually didn't realize I was doing venture capital. I had made up a fake title for myself called Lab Director for the Planet, because I was a former scientist. So that was a role that I understood. Because a lab director inside of scientific lab, they know all the projects in the lab. They make sure that the projects that are most promising are well-staffed, well-funded, that the research is connecting with industry or connecting with publishing in really productive ways. And, if there's a bunch of work in the lab that is less useful or could be more useful with some input, then they provide that input. And my thought was well, I just want to do a job like that. I want to do a lab director job, but where the scope is the totality of the planet and the purpose is the health of the planet. And ergo, the title Lab Director for the Planet. And that led to me meeting a bunch of these teams, helping them bring on the right staff, getting them the right sort of financial resources, doing all the stuff that a lab director does, connecting them up so that their work is seeing the light of day on the other side of things. And I realized a couple years into that, it's I'm basically doing venture capital. And that led me to wanting to learn how to do venture capital formally. So I worked at Crosslink Capital and also HackVC. And between the two, I learned a lot of what I needed to learn to go start my own firm, which I then decided to do in 2018 and kicked off in 2019.
Thank you for that understanding. Let's talk about then sort of your role now at once. So let's talk about the investing framework.
Yeah, so we're always looking for the triad, which is a disruptive deep tech, which is ushering in radically better unit economics paired with radically better environmental economics. And the better unit economics speaks to what I was saying before. Like a green premium, your best case scenario is to get a couple % market share. So that's just not going to change enough mass or energy to be interesting relative to changing how that industry works on the planet. So you definitely can't be more expensive, but would parity be okay? Because a lot of people that are in the green premium camp, they kind of say well, when we get to the world where this is just as expensive as that, as soon as this clean thing gets to the same OpEx as this dirty thing, we win. And that's no, you don't win. Because we've been out in the factories, and I will tell you what actually happens in that situation is, let's say current industry has got an OpEx of 100 blanks per, widget they're making. And then you come with the clean green option, which also has got OpEx of 100 per unit. Fantastic. Well, you have the clean thing, and it's got the same OpEx as the dirty thing. That's the holy grail, right? That's the crossover point where everybody's going to use the clean thing. No, if you go to the factory owner and you present them with that, they'll be okay, so let me get this straight. I can go from my dirty stuff, which is 100 per unit, and I can move over to your clean stuff, which is 100 per unit. And all I need to do is get rid of $100 million of productive CapEx to get it. And the conversation's over, right? Now, the fact that people even consider parity to be a spot that we should land at means that they're not spending enough time out in industry relative to the folks that are actually doing this work, because the people will give you that answer in 30 seconds. And I think we need to be realistic that that's not even an interesting goal, right? Parity is hardly even the starting point. I want to be nice and say like parity is the starting point, and as you get cheaper, then the game really begins. But in practice, it's nowhere. Like you can almost do nothing with parity. The only situation where parity might be interesting is if it's an industry where most of the build out is greenfield and you don't have much established industry yet. But if you have brownfield and you have a bunch of CapEx inertia where they need to upgrade equipment to get the clean OpEx, then sorry, you need to beat the unit economics by a lot. You can't beat it by, you definitely can't get to parity. And you also can't win by a nudge. And a nudge to me might be 5% better, 10% better. And I see lots of deals that are in that category as well. For us, the bar is actually substantially higher, and it's roughly whatever the margin is in your industry. So let's say you're in one of these manufacturing industries with a 20% margin. Well, we want to go find the deep tech that crashes the cost of production by more than 3x that margin. So you got 20% margin in your industry, we're going to crash the cost of production by 60%. And I will tell you that that level of OpEx win, that level of unit economic win gets people out of their seats. And we're seeing that in terms of the speed and intensity of revenue traction that our companies are getting once we get them over the manufacturing hurdle. Like once you get them over that, then, you know, things are taking off because people have been waiting for that type of unit economic for a long time. Now, what you want to do is you want those unit economics and the force that comes with that to be intimately paired, inextricably paired with the environmental benefits, right? So, for example, one of the largest wastewater producing industries on the planet is textile dyeing. And in one of our investments, the disruptive deep tech is a new machine that is able to go do textile dyeing in this compelling new way. The unit economics are 2.5 to 3x better in terms of the OpEx. So instead of costing 28 to 35 cents to go dye a length of fabric, it costs 9 to 15 cents to go dye that same length, right? So 2.5 to 3x cheaper in terms of OpEx. You know, the payback time on the machine is less than 2 years because of that. And then beyond that, it's pure profit. And these machines, you know, last 15 years, you know, plus. And the reason that we get all that OpEx savings is because we don't go and most of the OpEx inside of textile dyeing is used to heat water. So we actually get rid of all the water from the system other than the minimal amount of water that's required to carry dye into a fabric, which reduces the load of water by more than a factor of 1 million. And in that process, we actually get rid of all the heat that's required to go heat up all that water because we're dealing with a tiny fraction of the volume of water compared to traditional textile dyeing. So we save all that OpEx, which is just to say that the unit economic win is completely inextricable from the environmental economic win. The reason we don't have wastewater from that system is we don't even use it in the first place. And the reason that we get the OpEx win is because we don't spend all that energy heating up water. Now, when you get that going in the triad, then you get so many nice advantages. The first I already mentioned, which is you get those unit economics that drives insane sales velocity, excellent revenue growth, excellent market traction in a venture appropriate amount of time, especially in hardware businesses. People are concerned about that. I think we've cracked the code on that pretty well if you look at the revenue traction of our companies. But the other thing that you get is you don't need to worry about this triple bottom line, integrated bottom line kind of concept where you say, well, we have our economic goals and we have our ecological goals, and we don't want to go too hard on the economic because it starts to trade off the ecological and so on and so forth. It's like, no. If the unit economic and the ecological economic are that intertwined, then just to win economically is the same thing as winning ecologically. And that is so much easier in terms of the scaling of the business, right? If at every juncture we grew by 10x and we had to stop and be like, oh, are we now, overemphasizing the economical and now hurting the ecological? Whoops, now we got to retrench because, right, we're getting off track. If you have to do that, which a lot of businesses need to do because they don't have that intimate pairing of the two, then I don't know, it's like an anchor around your neck. And what you want to do is you want to have done the harder work up front. So those things are true. And then you can just go all out, like roll up the sleeves and scale a compelling business and just know the impact is coming alongside with it.
This is your number one framework, right? So I'm assuming that in some ways, 95 to 99% of companies that you talk to do not meet the triad for @1.
Substantially less than 5%. Yeah. Now, because the unit economics are really intense. Also, our bar for ecological economics is also quite high. You know, a lot of times like, oh, this avoids 1 million tons of emissions. And for us, it's like, nah, not that interesting. It's like, you know, at least hundreds of millions into the billions if we're talking about emissions reductions, because you need to go talk about it relative to the real scale of the problem. And I think that's the other place where people are fallen down a bit. You know, there's 50 billion tons of CO2e on a GWP of 100. And, you know, when your best case scenario is to get a fraction of a billion after 30 years, then it's just not interesting. And beyond the net output, which is the 50 billion, then we have the kind of the overage that we've already accumulated up in the atmosphere and the oceans, which comes out to closer to like 1.6 to 1.7 trillion tons. So one needs to think about like what it would take to go pay down 1.6 to 1.7 trillion tons, and growing, of course. Like each year that we don't get a handle on emissions, then that tally grows even further. And the rate that we're going to add at least another trillion tons to that tally before we actually round the corner and start, paying down our debts in the atmosphere.
So let's talk about your company. So I know it's like having kids. There's no favorites, but what is one or two examples of companies that you're really excited about right now?
Yeah, I mean, if I use the business lens, I guess I can throw out some stats. So we, in our fund one, so we did 150 million fund one with 27 bets in it. We are 5 bets into our fund two, and we are halfway through fund two fundraising as well, because we did our first close and we have, 5.5 more months to finish raising. We raised 215 out of 300 so far in fund two. Anyway, the stats on fund one. In fund one, we got in about 80% of our bets we got into pre-revenue. The other 20% had some revenue, but it's pretty low revenue, like 50K, 100K, sort of revenue. And circa today, with an average hold time of a little over 20 months, then we have 3/4 of our companies are now in revenue. So moving up quite a bit from 20%. Of the ones that, of the overall portfolio, half of it is in the millions in revenue. 7 out of 27 are above 10 million in revenue, and 2 out of 27 above 100 million. So that's a huge amount of traction in a short amount of time for physical businesses and climate. Honestly, if this is a software portfolio, 27 companies where you came in 80% pre-revenue, that would be a huge amount of traction. But this is what I mean by getting those unit economics right. Because I'm not running into a bunch of other fund managers that are getting this much business traction with their climate bets. Like they might have similar stats in terms of percentage of companies that have gotten to some type of revenue, but definitely not in this level of scale. So I look at that and, yes. And just to answer your question directly, well, because it addresses it very cleanly, because 2 are over 100 million, right? So we'll just talk about those 2. So one of them is actually Rome Electric, which is based in Nairobi, Kenya, and they're focused on the electrification of the African continent, and specifically building the vehicles that are appropriate for African roads and power infrastructure. So they basically have 2 contracts, one for 90 million, one for 30 million, that they're executing into right now, that are big purchases like B2B2C. And then the other one is Ascend Elements, which is best OpEx lithium battery recycling on the planet. So they're currently building the largest battery recycling plant in all of North America, and are going to end this year with, over 100 million in revenue and fully profitable as a company. So I'm very excited about that level of traction after this much time. So Ascend Elements was a pre-revenue deal when we invested, and Rome Electric had 100K, couple 100K in revenue in its entire history when we invested.
What else do the founders rely on you for as they're scaling, if anything? There's so many funds right now, especially climate, but the question a lot of founders will ask is sort of, are there specific value adds you provide, or why do people keep coming back to @ONE?
Yeah, so we led or had the largest check in 80% of our first placements in Fund One. So we both lead and follow, but we are leading more often than following, especially in our first placements. In terms of the specific value adds, then I would describe it that there's three places where we get our alpha. First is that we're an unusually technical team, which means we're good at identifying things that are going to work before other people recognize that they're going to work, just in terms of understanding the tech before you already have the commercial traction or already have all these other proof points that non-technical people can wrap their heads around. But that same technical expertise also helps us in terms of getting through any remaining engineering de-risk and getting over the manufacturing de-risk. So that's one source of alpha, like our technical skills can drive that kind of thing. Second source of alpha is we're very business fundamentals, so we're very used to helping folks build out the go-to-market, the realization of revenue, and we're quite good at helping our companies get to their first 5 to 10 million in revenue, as you heard from some of the stats a second ago. Like a bunch of companies well on that journey. The ones that are low millions, we're definitely going to get them up into high millions, in the next year or so. And it's just kind of like a pipeline for us where we're quite good at helping folks crack the code on how to break into their market. And remember, if you have those kind of unit economics, then people are wanting them anyhow, right? So the whole thing where you need to knock on 1,000 doors in order to close that first B2B sale, that's not our world. In our world, by the time a couple people actually understand the new unit economics and they can get over the level of comfort of the manufacturing maturity, then you're good to go. Things go quite fast at that point. Then the third source of alpha is a little bit unusual, but I call it entity janitorial, and maybe this will be less so going forward, but historically a lot of deep tech and hardware deals have had, fewer investors interested, and therefore they've sometimes accepted funkiness, where, this angel has a 3x super pro rata that's built in and it's going to like tank the next round, or, they spun out of this university with this oppressive, licensing term from the university. And a lot of folks look at that and it's like, oh, look, there's this mess on the deal. Oh, they have these advisors, they have these people that are really advisors, but they put them on the governance board. So the governance is a mess. So like a lot of people will kind of see these things and be like, yeah, it's a little too messy a deal. I got to walk. But the way that we look at it is it's extremely rare to go find the tech that can go beat the unit economics by that much. So that's rare. And what's not rare is lawyers. And if you can use some lawyers to go clean up, if you can use the unrare thing to clean up the rare thing, then you can create a lot of value doing that. So a lot of folks will look at that deal and it's like, it's 25% messy. Come back when you've cleaned it up. Then kind of telling the team that. But we'll look at that and it's like, no, you guys have got the unit economic at the core. This is like amazing. So let us work together to go clean up that 25% and then we'll get the deal done. All right, so we'll put in those cycles ahead of getting the deal done as part of leading, basically. So I think because of that, then, we've only lost one term sheet that we've extended. We've won all the other ones. So our win ratio is like north of 95%. So I think for the most part, entrepreneurs all recognize the kind of values that we're going to bring, even just from the first couple conversations.
So that's great. And let's talk about the process there of helping them. Like, what does that look like for once you fund a company? Is there like an onboarding period where they go through these things? Or is it sort of whenever they need help? Is there like a process to walk them through manufacturing and sales? Like, how programmatic is it? I think a lot of founders always ask me that. Like, okay, that sounds great. Like, how does it actually work in theory?
So it's actually pretty straightforward, which is the partners have a lot of depth in their historic backgrounds, and we can map the right partner onto the right deal. So Lori has a huge amount of background in biology and chemistry. She was heading up North America Venture for BASF before she joined us. And because of it, we can get her to be helping the companies that intersect with biology, chemistry, or materials. And then I've got a background in electrical engineering, software, including advanced algorithms and artificial intelligence. Because I built a lot of robots, then I know a bit of mechanical engineering, like the mechatronic aspect of it. So if you're like mechanical, electrical, software, or physics, then that's kind of my deal. And it's like, some of it is mapping to the right partner because that person just has a wealth of experience in kind of the zone that you're operating in. But then secondarily, we actually are always trying to find out from our portfolio companies what they still need the most help with. So at the end of 2021, we put out our annual survey, and we were the most helpful investor on the cap table for about 2/3 of our company. So we were number 2 for the rest. And I was like, whoa, how come we're number 2 on 1/3 of these? So you get our mindset a little bit. And what we found out is the things that we're missing is that they wanted a lot more support relative to hiring key folks for the team. They wanted more support in terms of being able to go to market and get their message out there in a clear way. And they also wanted more manufacturing support. So so we basically brought on hires for all 3 of those things. And at the end of 2022, like a year later, then we're getting extremely high marks on all 3 of those things. So like it works in an extremely practical way. Just like any design process, we are constantly getting feedback from our portfolio companies in terms of what's the center of gravity of that need, what's going to give them the most bang for the buck in terms of the hours that we're going to be together. Because sometimes people just throw more time at a thing, and that is sometimes a good indication. It's better than nothing, in terms of how you're supporting a team. But we also think about efficacy per minute, right? So we are going to spend some time with you, and obviously if there's more need, we will spend more time with you. But for even the regular things, just the regular checkups that we do, how do we get the most efficacy per minute? And like, what are the real challenges that are slowing you down? And we really kind of put the right people in place to address those challenges. And with any given, you almost think about it like a toolkit that you can draw from, because this particular company may not need manufacturing help right now. They may need, all their help may be in hiring. And then we'll send over the right resources related to that, and we'll focus on that with them. And then a different company is completely in the manufacturing, push right now, and they will be for the next 8 months. And that's really all we're going to do with them during that time period. And of course, fundraising is a backdrop for all of this. Like, we're always helping folks fundraise the next round. And we also set aside 1.5x the initial placement in reserves. Of course, you still got to earn it, but yeah.
I appreciate that. That's a really good way to think about sort of who needs the value add, how to give it to them. How about let's talk about hardware and software. So it's clear that you don't shy away from hardware. Outside of climate, hardware is still a 4-letter word for most investors. So let's talk to me about sort of what is your breakdown between hardware and software investing. And I know we talked earlier, but generally, like, what is your view also on sort of software-centric investing as well?
Yeah, so as of this moment, we have 32 portfolio companies altogether between Fund 1 and Fund 2, though we have 3 in post-term sheet diligence right now. So we're about to be up at 35. Out of 35 investments, we have 1 software investment. So that gives you the ratio. So 34 out of 35 are hardware physical. The reason to go do that is, by my best understanding, fixing the main things that need to be fixed for the climate, these are all physical industries. And I'm not saying that none of these industries use software at all, but a lot of the industries use no software or minimal software. Like there are steel plants and there's cement plants where, there's not a line of code running on the premises. Like if you want to argue that like a little bit of microcontroller code and a PLC, that's software. It's like, kind of. But like some premises don't even have that. So like you look at this like, well, that's where a lot of the emissions are coming from. Steel, cement, chemical separations and the petrochemical, industry, aluminum. And look, these are not software problems. And it's actually pretty hard to imagine how software goes in there and changes the important part of the mass energy balance, right? Because that basically comes down to just a physical process, which is not affected no matter how many lines of code that you write. Now, that means if you want to go fix that, you need to go and change the physical thing that's happening at the core. You can't just, change a bunch of software around the margins. So I would estimate that maybe only 5% of the climate problem can be solved with software, and 95% of it is going to be physical hardware, these sorts of things. So the first answer to your question is we do it in this proportion because that is appropriate for the problem, right? If you actually want to solve the problem, you got to go meet it in the proportions that the problem is at. But I think the other reason that hardware is a 4-letter word in venture is that we kind of got infected with this like software and enterprise SaaS disease. And because of it, everybody that does hardware is trying to enterprise SaaSify it, right? Like I got an inquiry from a entrepreneur that's like selling a device that like puffs up a pillow if it hears you snoring, and it's like supposed to like prevent you from snoring at night. And, my wife says I snore. So it's like, oh, I'll take a look at this thing, just as an investor, or maybe I'll just buy the product, right? Like, that's fine. I don't need to invest money. And when I went and talked with the folks, they're like, yeah, so it's like $300 up front and $100 a month subscription. I was like, the hell? This is like a bladder with a little, compressor. And it's like, I could build this weekend. What are you talking about? And like, what are you talking about? You're going to charge me $100 a month for perpetuity for this. This is insane. So like, people are basically handicapping themselves. Like literally that doesn't make any sense. Like it doesn't make sense even prima facie. The only way that it makes sense is a bunch of investors pressured them into being like, but tell me about your recurring revenue. How come that's not big enough? And it's like, guys, you're sinking the business. That's not what this thing is, right? Let hardware be hardware. And if you forgot that people can make hardware, money in hardware, remember the place is called Silicon Valley. It's not called Lines of Code Valley, right? Software is a pretty recent situation here. The first 3.5 decades were all hardware. So we had a decade and a half of software. Congratulations. And I think we're maybe running out on that now, because the software I'm seeing today is not the corner thing, which is like, oh, we index all the world's information, or we make anything purchasable, from anywhere in the world. Like those are pretty big problems, right? Like the software that's being pushed forward today is, I don't know, honestly, a little bit trivial. And we see this like in terms of when the thing is conventional wisdom like that, everybody starts doing the same strategy and it stops becoming that lucrative a strategy. And I'm not saying that you can't make any money in software anymore, but I will say that we've gotten terrible at software. And what I mean by that is like, Google was venture backed as well, but Google raised less than $200 million in its entire history. And by the time it had raised that capital, it was growing off of retained earnings and growing like a rocket ship and ultimately, obviously, grossing hundreds of billions of dollars now, right? If you compare that to Airbnb raised $6 billion. Now, do you think Airbnb is 30 times harder to write than Google? Of course not, right? Airbnb is a listing site that is, some hard user experience work, but it's not necessarily the same as indexing all the knowledge on the planet. So I would just say technically less hard. And yet they spent 30 times more. And honestly, Airbnb is nothing of the business that Google is in terms of profitability, margins, intensity of growth, or even future prospects. So you kind of look at that and you're like, wow, maybe we just got sucky at this. Well, everybody said that, software is going to eat the world and all, venture needs to move to software. Maybe that was basically the declaration that we're going to become undisciplined and kind of bad at it. And look, Airbnb is like middle of the road, right? That's like still 10 years ago when we would say we're still pretty good at software investing. And you fast forward to now, I think we're actually actively worse than we were, when we were doing Airbnb, which was actively worse than what we were doing when we were doing Google. So, yeah, I mean, the Valley can say what it wants on that side. And if they're getting great returns, then congratulations to that. But I'll tell you that the revenue traction in our portfolio outpaces almost every software portfolio I've met of similar fund size and vintage.
Do you worry about, as an investor, the dilution that occurs with these hardware companies that just need a lot of money to sort of get to the same level as some of these software companies, or do you see it differently because they're enterprise centric and the capex and all the other triad aspects?
So if you do this right, you can play an extremely different playbook, because that is also the other conventional wisdom. It's like, if you get into a hardware business, you got to raise, $1 billion in equity. Otherwise, you're not going to be able to see it through. And, Rome Electric, which is the, one of our two businesses that's over 100 million booked, right? They raised less than 15 million to get there. So I don't know. I mean, I can give you a bunch of proof points where the amount raised was quite small compared to the revenue and bookings logs so far. And this has a lot to do with those winning unit economics, right? Because if you can actually introduce winning unit economics to the world, then you're instantly supply limited. And as soon as you're instantly supply limited, then amazing things can happen in terms of the growth of your business. It means that every single unit that you produce, you will sell. So you don't end up with a bunch of COGS, inventory inertia, where you just got a bunch of money caught up in atoms, or you have this kind of forecasting issue where it's like, oh, we overproduced and everything's caught up in atoms, or we underproduced and we're leaving all this money on the table. Literally everything that you make, you're going to sell, right? And when you have that kind of thing on your side, then it gives you so many other options. Like our specific playbook is when we work with teams, by the time they're done using the proceeds from their seed round, we want them to be logging real revenue from their real customers. This is why so many of our early stage companies are in revenue already, right? Because we're doing that playbook. By the end of the A proceeds, we want them to get to gross margin positive manufacturing on their core product or service. And we get that with most of them. Some of them, spill into the B round as they're trying to get that going. But most of them, yes, are able to get that done by the end of the A round. Now, if you're able to get both of those things done, then it means by the time you get to the B round, you can hybridize the finance stack between equity and debt. So instead of raising a big equity round where all that equity dollars go to every kind of thing, you can divide it so that the equity dollars go to things that can have equity level returns, so really nonlinear returns. And the debt dollars go to things that can only have debt level returns. So things like capital equipment, facility build out, COGS, inventory, a line of credit to go manage the cash as these things are moving about, then those should all be debt financed. Now, in the B round, you don't want to go overboard, right? If you did all debt in the B round, you might run into a situation where it doesn't hang and you end up with negative liquidation and the equity holders end up with nothing because debt has got preference over equity in liquidation. But if you do it in the right proportion, then you stay really safe, in terms of how much debt you've raised versus equity. But you basically have started the chain, which dramatically reduces how much equity you're going to need to raise in the long run. Because in the B round, it might be 80-20. In the C round, it might be 50-50. In the D round, you don't have an equity-based D round because it's all debt at that point. And, that basically massively blunts late-stage dilution. It massively reduces how much capital needs to be raised for these companies to get to interesting revenue levels. And you already heard a couple that are interesting revenue levels actually given relatively small capital raised. And it also helps the companies because if they ever are going to go achieve their mission of really displacing the damaging industry or building a huge generative industry for the planet, then most of that scaling is going to happen through debt. That's just the way that business works at global scale. So once a thing is making 5 billion, 10 billion, 50 billion a year, then most of the scaling of their facilities came through debt. It did not come through equity dollars. So yes, we're basically getting people to learn that skill in the B round, and it gets them set up way ahead of time. Like the worst case is, and we've seen this from the Valley too, which I think is bad behavior. You might as well feed your founders to the wolves. But they equity finance the thing all the way through some kind of SPAC. And then they say, well, good for you. Now you got these public dollars and go raise some debt dollars and figure out how to use debt from now on because no more equity rounds. And a lot of the people are like fish out of water at that point. They've never, been used to managing, cash in that style, where there's cost of capital included, where there's different covenants, where there's things that you need to do to be good at debt. And our founders are learning this in the B round, so that by the time they're going IPO, then they're just well suited. It's just copy paste.
Let's talk about sort of the founder out there right now thinking what we use the word a lot, underfunded, but let's talk about another term, underfounded, right? So if you're a capital allocator right now, a company builder, where do you want founders the next 10 to focus that pitch at one that you think are the most underfounded opportunities?
Yeah, I mean, I think everybody naturally gravitates to the sexiest opportunities. And there is some logic to it. Like actually, if you look at the amount of dollars that are going into green tech, climate tech over the last couple of years, there's a huge, uptick in 2020, 2021. But if you decompose it by sector, a lot of that went into mobility, and it went into like the sexiest things in mobility, which is like the vehicles. And you look at that and you're like, okay, definitely there's some good business to be done there. But like whenever you have that kind of overage where everybody's into a thing and nobody's into another thing, then that kind of imbalance basically says that there is opportunities that people are not, considering well. Now, that said, if there is going to be a bunch of critical mass around actual vehicles and mobility, fantastic. Like there is some wisdom in founding in that space because it means that there's a bunch of investors that are actively looking or have recently deployed in that space. So they've indicated that they can go in that space. But I think we kind of overdid it, and there was way more critical problems. So one of our most recent investments is in a company called RevTerra, which basically solves the fast charging interconnect problem. Because, people talk about charging infrastructure and they're like, oh yeah, ChargePoint's basically got it. They're installing a bunch of things or whatever. A couple of networks have basically got it. They're the biggest networks. But you look at ChargePoint, it's almost all level 2 chargers, right? And it's not because level 3 chargers that are, and a level 2 charger, you might get 15, 20 miles of range in an hour. So you like go shop for an hour and you come back with, 20 miles of range. It's not that great a consumer experience. It's a long time to be able to get that charge. Fast charger, you might get 3/4 of a tank or a full tank in, 5 to 10 minutes. And it's like, okay, well, that's obviously way closer to what we would want, from our vehicles. So why in the world, do we not have way more fast chargers? Well, it's not actually because of the CapEx expense. Fast chargers are not insanely more expensive than type 2, level 2 chargers. It's actually because of the interconnect issues, which is fast chargers draw a lot of current and you can't site them everywhere on the grid. And there's a lot of places on the grid, if you were just to set up a bunch of fast chargers, then you imbalance the grid in a way that's going to both damage the grid and damage your service level. So like you typically have fast chargers right now in the places where the grid is ready for it, not where consumers need it. And I was seeing very few companies that were trying to solve that problem intelligently compared to how many people were going into the vehicles. Now, of course, if you get the vehicles, you're going to need this charging infrastructure as well. So like, almost imagine there's a tip of the iceberg, which is like the visible part of an industry that's real sexy and everybody wants to be in. And then there's 90% of physical industries, which are the less sexy part, where no, that also needs to be working and running. Now, that said, on one hand, it needs to happen for the big changes to happen on the planet. On the other hand, I understand why some entrepreneurs are scared to play there because they are not seeing enough investors deploying capital in that space. Because the same shiny object issue for the top of the iceberg for the entrepreneurs is true for the investors as well. But I will tell you that, one could do a strategy, which is not unlike our own strategy, where it's like, well, let's start to make inroads, because obviously lots of capital at the tip of the iceberg, but let's just move, 3 meters below the water, because there's still a lot of iceberg there, right? And let's talk about the things that are immediately adjacent to what is visible over the surface, where it's obvious why you would need this in order to do that. And let's go invest in those sorts of things, right? Because our other company over 100 million is in battery recycling. Well, battery recycling is related to mobility, right? Because mobility is going to be the largest user of batteries as an industry, in the foreseeable future. And given that, they're going to be the ones that have the largest need for battery recycling. So that's actually, been an extremely successful bet for us. It's immediately adjacent to the money that was going into mobility, which meant that we were still able to attract enough investors to play. But we also end up, we're now building the largest battery recycling plant in North America. We are now meaningfully contributing to the ability for at least this continent to be able to go step up to the challenge. So that's where I'd encourage people to, from the founding side, to kind of expand their aperture and start looking like, what's the stuff that's adjacent to the sexy stuff, but is less trodden, but it's obviously going to be needed for things to work.
It's amazing, Tom. Look, every time I talk to you, I feel like I've taken a class in climate technology for a semester in an hour. So I really appreciate the time today. Everybody can find you at One Ventures online, also on Twitter. Tom, you're on there. But I really want to thank you today for your time. And I'm excited to see what the company and the firm and you and your portfolio companies do moving forward. Very, very inspiring to all of us. Appreciate it.
Thank you. Great to chat today.
Well, that's all for this week's episode of Climb by VSC. As always, thank you so much for watching and listening. A few quick shout outs before you go. Our thanks to Tom for sharing his wisdom with us today. You can learn more about @One Ventures at their website, @oneventures.com. Special thanks to Credo for their help in promoting and producing this episode. If you want to hear any part of this conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for posting these every week. Lastly, if you're still listening, please leave us a rating on Spotify or a review on iTunes. It really helps us out, only takes a few seconds, and as far as I know, it's still carbon neutral. Well, that's all for now. We'll see you next week on Climb by VSC.